Good afternoon. This is Tom Asper with the Viper Report. It's Monday, February 3rd, starting off a new month. Most of you probably know that stocks really got hammered on Friday. That was in line with the negative signals from the advanced decline lines that I follow from early in the week. I've been warning for the past several weeks that the risk was high in the market. This was an article from January 26th of 2020. Indicating the increase in bullish sentiment. Too many investors were getting bullish, and the market looked like it was overextended. If you look at this chart here, you can see that the QQQs, which is the NASDAQ 100 ETF, it's been the strongest part of the market. I do relative performance analysis. It's been our favorite. You can see it formed a doji with the close on January 24th. This turned out to be the market high, and you also see the daily chart shows a reversal on the 24th, that Friday. We had quite a bit of bearish action where the market would open strong, close weak. This was really accelerated. We gapped higher in the open, then closed down, and that was a sign that too many people were chasing prices higher. Some of you may be familiar with my Stark Band analysis. You can find it on viperreport.com, and it gives you the risk of the market based on probability. So when we're near the lower bands, like we were here in June, we're near the lower bands there. That's a low risk time to buy and a high risk time to sell. So as we closed on the 24th, we were up above the upper band. So that's a really high risk time to be buying, and it's a low risk time to be selling. So and we've declined pretty sharply from that level. In last week's contribution to Forbes.com, I talked about the technical secrets I use to analyze stock market sentiment. You can't just buy when the sentiment is low and sell when the sentiment is high. That doesn't work. And you need technical signals, in my opinion, in order to time that, and it'll tell you when you should be getting in, buying, or when you should be getting out. This is one of the charts in the article. So we have the S&P 500. We have the S&P 500 AD line, and below that we have the bullish percentage reading from the American Association of Independent Investors. So you can see in the fall of 2008, the AD line had started to top out by early October, yet the bullish percentage shot up to 45.7. So when that happens, and my analysis that I teach about the AD lines is negative or corrective, that's a real warning. You can see it was pretty ugly for all that quarter, but the sentiment actually bottomed out on the 10th of December. Here it got down to 20.9. So it went from 45.7 to 20.9. But just because it was that low, if you bought here, you had a lot of pain. We lost about 200 points in the S&P in this Clyde. So by the time we got down to the low at the end of the year, the AD lines turned around, as I discussed in the article, and then that was the safe time to be a buyer, and that you knew that the sentiment had got to be pretty low levels, which is a good requirement to establish long positions. The last chart I want to show you today is another way I measure the risk of the market, and this measures the number of stocks above the 50-day moving average in the S&P. So when it's really at high levels, 80 to 90%, that's a sign if the AD lines start to top out like they did in May, late April, early May, that's a sign that the market is ready to correct like it did in here. So we've been at very high levels for the past month or so, and now finally the AD lines started to turn negative, and that said, okay, we're going to go from a high risk to a low risk market. You can see we've dropped some, but don't really think we bottomed yet. These were the buying opportunities I sent you emails about in August. We got very down to the low risk area also in October. But for the past couple of weeks, I've been saying, that was the time to be buying. Now is the time to keep your powder dry, raise some cash, and there'll be a good buying opportunity ahead. And that I still think is the case. So the market is rebounding sharply on Monday. My analysis doesn't suggest that the worst of the selling is over, and unfortunately the news about the virus is probably not going to get better for a while. So we're still on the sidelines looking for the next good buying opportunity. Of course, we have some long-term positions that we're holding that have been doing well, particularly in utilities. If you'd like to learn more about my services, you go to viperreport.com. If you want to learn more about technical analysis, you might click on the 2-to-your trade. It gives you 90 minutes where I can teach you some technical analysis or evaluate your understanding of technical analysis to see whether you need more work. I'm a strong believer in teaching people how to become better analysts, and I've had a pretty good success rate. If you aren't a subscriber to the Viper ETF report or the Hot Stocks report, you can click on either one of these links and it'll take you through to PayPal. You can sign up and you'll be immediately put on the mailing list. The next issue goes out on Thursday morning before the open. Well, it should be another interesting week. Last week was pretty wild, and we've been doing a bunch of special updates. So we'll try to get back to you by the end of the week. Thank you very much.